Ever feel like you're trying to grasp something super complex, but time's just slipping away? You want those big insights, the ones that really shift your perspective.
Yeah, absolutely. Those aha moments.
Well, that's precisely our goal today. We're diving deep into the historical forces that have shaped how wealth and income are distributed, the stuff that really impacts your life, using 15 years of research, a massive undertaking that culminated in the book Capital in the 21st Century. Think of this as a fast track to understanding the really foundational changes in how our economies actually work.
And it's not just one person's work in isolation. This research spanned from 1998 to 2013, built on collaborations, especially with Anthony Atkinson and Emmanuel Saez. Those names might ring a bell.
Oh yeah, I remember their work.
Their findings about the huge surge in the top 1% income share in the U.S., going all the way back to the 70s and 80s. Their work on optimal taxation, too, for income and capital, really foundational stuff. Those partnerships were crucial for the insights we'll be unpacking today.
Totally. And our mission here is clear: to pull out those crucial insights about how capital and income have evolved over time, how they've become concentrated, really get a grip on the forces that have shaped inequality as you experience it today. We'll be drawing straight from the historical analysis and the economic frameworks laid out in this impressive body of research. All right, let's get into it. Let's rewind way back to some of those early economic thinkers. What were they wrestling with when they looked at wealth and society?
Well, back in the early 19th century, Ricardo gave us a key early insight: the scarcity of essential resources. Take land, for example. It can be a massive driver of inequality, even social instability. He saw that the price system, while efficient in many ways, isn't inherently fair or self-regulating when it comes to things like this, something that still feels relevant today. When we think about housing costs, access to resources, the price of those essential things. He grasped that as populations grow and the supply of those things stays limited, their price can just keep going up, potentially destabilizing society.
So it's not just about how much wealth is out there. It's about who controls the essentials, how their scarcity concentrates economic power. Then you have Marx, coming a bit later, building on those ideas but focusing on industrial capitalism.
Marx, writing mid-19th century, took Ricardo's framework and applied it to industrial capital, not just land. He focused on what he saw as the inherent contradictions within capitalism itself. He proposed what he called the principle of infinite accumulation. The idea was that capital would relentlessly accumulate, becoming concentrated in fewer and fewer hands with no natural limit or balancing force. This insight about capital's tendency to concentrate is still a really hotly debated and important one when we try to understand these long-term trends.
And Marx saw that relentless accumulation leading to some pretty dire outcomes, right? Not exactly a recipe for stability and prosperity in his view.
Not at all. He predicted it would lead to capitalism's collapse. He saw two possible paths. Either the return on all that accumulated capital would eventually drop, leading to crises among capitalists themselves, or the increasing share of income going to capital would make the working class so poor that they'd revolt. He didn't see a way for capitalism to settle into a stable, equitable equilibrium.
A pretty bleak forecast compared to the, I guess you could say, optimism after World War II. What changed that outlook?
Post-war optimism was heavily influenced by Simon Kuznets. He developed the first comprehensive U.S. national accounts data, also created measures of income inequality over time. And his work seemed to indicate that as economies developed, income inequality actually declined. This led to what became known as the magical Kuznets curve theory.
Magical? That sounds almost too good to be true.
It did, right. It proposed this almost automatic process. As countries industrialized, inequality would naturally follow this inverted U-shape. It'd rise early on, peak, then finally fall as wealth spread more evenly in mature economies. But, and this is key, this theory, as we understand it now, was based on somewhat shaky evidence and formulated for, well, the wrong reason.
Wrong reasons. Tell me more.
So that sharp reduction in income inequality seen in most developed countries from 1914 to 1945 wasn't because workers smoothly transitioned from farms to factories, naturally sharing in the gains like the Kuznets curve implied. It was mostly due to the huge violent disruptions of those two world wars, the economic and political upheavals that came with them. This hit those holding large fortunes particularly hard. It wasn't this peaceful, gradual evolution towards more equality.
So that apparent move toward greater equality in the mid-20th century, more about destruction, disrupting existing wealth structures than some inherent feature of capitalism's progress. A sobering point. But how do we even know all this? What kind of data research methods are we talking about to track these long-term trends in wealth and income?
Piecing together reliable historical data, that's a massive task. A crucial resource for studying income from capital has been the World Top Incomes Database, or WTID. It combines data from income tax returns across numerous countries, giving us a ton of information about how income from various sources, including capital gains, dividends, has evolved over the 20th and into the 21st century.
But income's only one part of the picture, right? What about the actual distribution of wealthy assets people own?
Absolutely. To really understand wealth inequality, the research uses three main approaches. First, analyzing estate tax returns in detail. This method, pioneered by Robert Lampman in the US, was expanded by Atkinson and Harrison in the UK, and later applied to France and Sweden. It lets researchers track wealth distribution at death, and interestingly, in some countries, this estate tax data goes further back than income tax records, so it provides this longer historical lens.
Looking at what people leave behind tells us a lot about what they accumulated during their lives. What's the second method?
The second approach is using historical data directly collected by governments. France is a goldmine here. Records allow analysis of wealth concentration going all the way back to the French Revolution. That long view is invaluable. It reveals the deep historical impact of events like world wars on wealth in ways that income data alone often can't.
And the third piece of this historical puzzle.
In-depth studies of specific countries, like Romain and Waldenström's work on historical records in Sweden. By meticulously piecing together info from archives, they reconstructed long-term trends in wealth inequality just within Sweden.
So this combo of tax data, estate records, and deep dives into archives, that's how we build this long-term picture. You mentioned figure I.1, which shows that U-shaped pattern in U.S. income inequality. Walk us through that.
It's a striking visual story. It shows the top 10% in the U.S. held a large chunk of national income early 20th century. 1910s, 1920s, around 45–50%. Then, a significant drop, bottoming out below 35% in the 1950s. That's the Kuznets decline. But from the 1970s, reversal, and by the 2000s, 2010s, it climbs back up to that 45–50% range. There's your U-shape.
And what's behind that big rise in U.S. inequality in recent decades?
Interestingly, this spectacular increase, it's not primarily driven by a surge in income from capital from investments. Instead, it reflects what the research calls an unprecedented explosion of very elevated incomes from labor, especially among top executives and managers in big corporations.
The rise of supermanagers with skyrocketing salaries.
Exactly. There's debate about why. One argument, their skills productivity have dramatically increased. But a more compelling explanation, and one that the evidence supports better, is that these folks have huge power to set their own compensation, and this compensation might not have a clear link to their individual productivity, which, in a massive organization, is tough to measure accurately. This is most obvious in the US and the UK.
So is the U.S. experience universal? Can we expect this same pattern, driven by top labor incomes, to play out everywhere else?
Not necessarily. The U.S. might be unique. Its demographic history is different, higher population growth than many European countries. Historically, this meant inherited wealth played a less dominant role in the U.S. economy compared to older European societies. So thinking about the future globally, a country like France, with its longer history of slower demographic growth, might actually be more indicative of what's to come on a global scale.
Fascinating demographics, setting the stage for how wealth and income dynamics unfold. And thinking of France, the outline mentions the French Revolution, its ideals of equality. How did those revolutionary ideas impact wealth distribution in the long run?
The French Revolution was this radical departure from feudal systems. It put immense emphasis on legal equality in the marketplace. Later, in the 19th century, you had conservative economists in France arguing that this meant no need for progressive taxes on wealth, unlike in aristocratic Britain. But data clearly shows wealth concentration in France remained as high as in Britain, a crucial point. Simply having equal rights in the market doesn't automatically create overall economic equality.
Equality on paper isn't equality in reality, a lesson that still resonates today in conversations about economic justice. Let's talk about the data itself. National accounts, these big aggregate measures of the economy, are described as a social construct. What does that even mean for interpreting these figures?
It's an insightful point. National accounts, they're not just objective facts out there in the world. They're compiled, organized by agencies, using different sources, making methodological choices. They reflect priorities, preoccupations of the time they were developed in. We can't treat them as perfect, unbiased reflections of reality. They're tools with limitations, compilations from diverse, sometimes inconsistent data.
So not like looking at irrefutable scientific data. There's interpretation involved in building these accounts.
Exactly. We shouldn't make a fetish of the numbers. However, used carefully, critically, ideally alongside other types of data, they're essential for understanding aggregate income, wealth, those big long-term trends.
And comparing figures across countries, we need to be careful about using simple exchange rates versus purchasing power parities, right? Why is that distinction important?
It makes a huge difference, especially when comparing global inequality or living standards. Exchange rates, they fluctuate with currency markets. PPPs, purchasing power parities, they reflect the actual buying power citizens have within their own economies. People mostly spend their income in their own country, so using TPPs gives a more accurate picture of their actual living standards. Someone in one country might earn fewer US dollars when converting at the market exchange rate compared to someone earning euros elsewhere. But if things like groceries, rent are much cheaper in that dollar country, their actual buying power could be similar. That's what PPP captures.
It's about what your money can buy where you live. Let's zoom out to global capital ownership. Early 20th century, what did that distribution look like?
In 1913, right before World War I, European powers, they owned a massive chunk of capital in Asia and Africa. Estimates suggest between 1/3 and 1/2 of the total domestic capital in those continents and over 3/4 of industrial capital.
A reminder of colonialism's economic reach. Now, classical economics often suggests that free capital flow leads to convergence, richer and poorer countries becoming more equal in wealth and income. Did that prediction pan out?
The theory is, rich countries, lots of capital, maybe lower returns. Poor countries, less capital, potentially higher returns. So capital should flow from rich to poor. This would boost productivity, wages, and ultimately lead to equalization. But the reality, much more complex. Some convergence happens, sure, but not that smooth, consistent process the early theories imagine.
Economic theories offer frameworks, but the real world is messier. Let's talk demographics now. How do population shifts affect these dynamics of wealth and income?
Demographic shifts are huge, often unpredictable. Think about decisions to have kids, influenced by so much. Culture, economics, individual psychology, even government policies, everything from good schools, affordable childcare, to gender equality in society.
And individual family decisions about demographics, those can have huge long-term consequences for the broader economy, right?
Absolutely. Take France, 18th century, most populous in Europe. But their demographic transition falling birth rates happened very early. Now, projections say France's population might actually surpass Germany's in coming decades, a big reversal. These demographic shifts have huge economic and social effects, and the causes behind them are really hard to pin down.
What about population growth and inherited capital's importance?
When population stagnates or declines, especially with low economic growth, it can actually boost the influence of inherited wealth. Fewer new people, less new wealth created, so existing wealth, inherited wealth, becomes a bigger part of the economy. This suggests we're likely to see a comeback of inherited wealth globally. It's already happening in many European countries.
That challenges the idea that modern growth automatically makes your family background less important. Also, there's this notion that growth mainly rewards individual talents and merit. What's the nuance there?
Sure, a growing economy can create more opportunities, but this idea that it solely reflects individual talent has been used to justify a lot of inequality historically. Charles du Noyer, 19th century economist, argued industrial society eliminates artificial inequalities but reveals natural ones. He used this to oppose social legislation, believing it'd stifle progress, go against this natural order.
So a seemingly meritocratic argument used to defend the status quo, regardless of inequality.
Exactly. It's crucial to be critical of such arguments. Look at the evidence, think about who benefits from those narratives. Now, let's look at long-term data on global growth. What does it tell us? From 1700 to 2012, global per capita output grew about 0.8% annually. Seems small, but over 3 centuries, that's a tenfold increase. In real terms, average global income today around 760 euros per month. In 1700, it was less than 70, comparable to the poorest parts of Africa today.
That's a huge change over time. But the outline cautions against oversimplifying comparisons across such vast periods. Why is that?
Comparing societies centuries apart with just one number is misleading. Economic development, it's multifaceted. How we live, what we produce, consume, overall quality of life, it's complex. Can't be captured in a single figure.
It's not just about having more money. It's about entirely different kinds of lives. The outline also mentions the evolution of prices, How have the benefits of technological progress been shared?
Looking at price changes relative to purchasing power, it shows progress hasn't benefited all sectors equally. Take France since 1900. Purchasing power for carrots increased sixfold in line with overall growth. But dairy, with advancements in processing, saw even bigger gains. Staple foods like bread, meat quality improved, but purchasing power increase was less dramatic.
So your money goes further for some things than others, and then there are crucial services like healthcare, education, often tax-funded. How does that complicate comparisons of living standards over time?
In developed countries, healthcare, education, often at least half the cost. More in Europe are tax-funded. So direct monetary comparisons are tricky because these benefits aren't fully reflected in income figures. But improvements in life expectancy, literacy, those are tangible results of public investment.
You can't put a price tag on living longer, having access to knowledge. The outline mentions the post-war catch-up period for Europe relative to the U.S. What happened there?
After the devastation of the wars, Europe lagged behind the U.S. The period from 1950 to the early 1970s, the Trente Glorieuses in France, saw rapid European growth. Rebuilding, adopting U.S. technologies. Once caught up, both regions reached the technological frontier. Growth since then has been more similar, generally slower.
That post-war boom was specific, tied to recovery, not the norm. Finally, there's inflation disrupting pre-war stability. How has inflation evolved long-term?
From 1914 to 1945, that shattered the stability of before World War I. Inflation remained high for decades, particularly in the 1970s. But 1990 to 2012 saw a return to lower levels in many developed countries, closer to the near-zero inflation of the pre-World War I era, but not quite there.
A roller coaster ride for inflation over the past century. Now, on to the capital-income ratio. The research focuses on its evolution, the changing nature of assets. Why is this ratio so important?
The capital income ratio, beta ABBO, it tells you how important capital is overall in an economy. You take the total wealth, divide it by total annual income. Seeing how it changes differs across countries. It reveals a lot about wealth structure, its link to economic activity, and how it might be changing in ways that impact you directly.
The research looks at Britain and France, going back to the 18th century. What were the big shifts in what constituted capital during that time?
Historically, net foreign assets, what a country owns abroad minus foreign ownership within it, have been relatively small for Britain and France even today. The key change: farmland being replaced by real estate and working capital investments in businesses. Interestingly, total capital relative to national income remained fairly stable for a long time, until more recently.
So wealth's form changed dramatically, but its overall size compared to income didn't. Can you give us current figures for Britain and France?
Right now, per capita national income in both countries is around 30,000 euros annually, but their national capital, all the assets, is about 6 times that, roughly 180,000 euros per person. This is divided into housing and other domestic capital, company investments, infrastructure, and so on.
And the line between financial assets like stocks, bonds, and non-financial assets like buildings, equipment, that's not always clear-cut, is it?
It can be blurry. Think about privatizations like France Telecom or the post office. State-owned buildings, infrastructure, previously non-financial assets become financial assets, shares in a company.
It all depends on ownership and how it's categorized. What about public assets, things the government owns, and public debt?
Right now, public assets in Britain are about 1 year's national income. In France, a bit less, around 1.5 times, but public debt is also high, roughly 1 year's income in both. So net public wealth assets minus debt is near zero in Britain, slightly positive in France, but still less than 30% of national income compared to that vast private wealth.
And historically, low net public wealth seems to be the norm for these countries.
Yes, going back to the 18th century, net public wealth has been small compared to private wealth, sometimes reaching 700–800% of national income. Fluctuations have happened due to wars, crises, but they're small compared to the massive private wealth.
Figure 4.5 shows European national capital at 2 to 3 years of income around 1950, much lower than today. What caused that?
The world wars. The economic and political shocks were more devastating to capital than the fighting itself. Collapsing foreign assets, low savings, and depressed asset prices post-war all contributed to a huge drop in the capital-income ratio between 1913 and 1950.
War's impact goes far beyond the battlefield. The outline mentions Canada shifting from a debtor to a mostly Canadian-owned economy. That's different.
Yeah, unlike those European powers, Canada was a net debtor. But especially after World War II, things changed. Today, domestic capital is around 410% of national income, foreign ownership less than 2%.
Significant domestic ownership. We can't discuss U.S. capital, especially historically, without addressing slavery. How were slaves accounted for?
It's a dark chapter. Slaves were legally considered capital property, assets. To illustrate, Thomas Jefferson owned over 600 slaves. The U.S. slave population exploded between the late 1700s and mid-1800s. Figure 4.9 shows that around 1770, the market value of slaves was equal to 1.5 years of U.S. national income, as much as all the land.
Staggering. It underscores the economic scale of this injustice. How did the South's capital structure, including slaves, compare to Britain and France?
The comparison is stark. Southern slave owners actually controlled more wealth than old European elites because they owned both land and the labor force working that land. They concentrated both factors of production as capital.
A disturbing comparison. Moving to recent times, there's this comeback of private capital in wealthy countries since the 1970s. What's driving this?
Since the 70s, there's been a clear trend: private wealth growing relative to national income. By 2010, it ranged from 4 to 7 years of income, up from 2 to 3.5 in the early 70s. This points to new patrimonial capitalism, where inherited wealth is gaining importance. Rising asset prices, especially for real estate and financial assets, have been key drivers.
So rising house and stock prices are major contributors. You mentioned the formula Bapley says G. Explain that and its importance.
It's a fundamental relationship. Long-term, the capital income ratio tends towards the saving rate, S divided by the economic growth rate, G. Think of it this way. High saving, slow growth existing wealth grows faster than new income, leading to a higher capital income ratio, potentially more concentration. If growth is high relative to saving, the ratio tends to be lower. Europe historically had a higher BAP than the US, aligning with its higher saving rates, slightly lower growth. The decline in Nickler from 1910 to 1950 matches periods of low saving and war destruction, while the faster rise from 1980 to 2010 is linked to slower growth.
A powerful framework for understanding these shifts. What happened to those large foreign asset holdings wealthy countries had before World War I?
They largely vanished after the shocks of 1914 to 1945, the wars, the Depression. Net foreign asset positions have stayed much lower since. The recent rise in national capital mainly reflects domestic capital growth, housing, business investments within their own borders.
A shift from holding wealth abroad to holding it domestically. Let's move to returns on capital and how income is divided between capital and labor, a key to understanding inequality.
Absolutely. When analyzing the economic pie, we look at how much goes to capital owners, profits, rents, interest, and how much to labor, wages, salaries. One challenge is mixed incomes. Common for self-employed folks, separating their labor income from capital income is tricky. The research often uses the average economy-wide split to estimate, though with more uncertainty for earlier periods.
You mentioned 19th century novels assuming a 5% return on capital. What does that say about perceptions of capital back then?
Novelists like Balzac and Austen treated land and government bonds as almost interchangeable sources of reliable income, yielding a steady 5%. This reflects how capital was seen back then in a time of low inflation. It was stable, dependable, ensuring social status across generations. The form mattered less than that steady stream of income.
Capital, a guaranteed way to maintain social standing. What about actual returns on capital in recent times?
The average pre-tax return in developed economies after inflation is 3–4%. But this hides huge variations. Small checking accounts might see negative real returns. Savings accounts barely keep up with inflation. Most wealth is in stocks, bonds, real estate. Their returns drive the overall average.
How has the shift from near zero to 2% inflation affected the real return on capital?
The transition probably hasn't had a huge impact on the underlying real return. It might create complications for those on fixed incomes, but inflation mainly redistributes wealth among those who already have assets, rather than significantly changing the average return itself.
It shuffles existing wealth, doesn't drastically change the overall returns. What determines the rate of return on capital in the first place?
Two main forces. Technology, how productively can capital be used? What innovations boost output? And capital abundance. If there's lots of capital relative to investment opportunities, returns tend to decrease. Imagine, if capital had zero productive use, its return would be zero, regardless of how much there was. All income would go to labor.
A helpful thought experiment. What about the Cobb-Douglas hypothesis, which posits a stable capital-labor income split over the long term? Does that hold up?
Not entirely. While the shares might be stable long-term, there are significant medium-term shifts. The early Industrial Revolution in Britain, 1800 to 1860, saw capital share increase by around 10% at the expense of stagnant wages. Engels called it a pause in living standards. Interestingly, this shift partially reversed later.
So we see lasting changes in how income is divided. What about Marx's use of statistics? What's the critique there?
Despite his insights about capitalism, Marx's use of data was often anecdotal, not always systematic. He missed the emerging field of national accounting, the attempts to estimate Britain's capital stock. Some argue that engaging with this data could have strengthened his arguments.
Even brilliant minds can overlook available data. Lastly, the Herod-Domar model. What's its key takeaway about capital and growth?
Developed in the late 1930s, it saw the capital-income ratio as fixed by technology. This meant economic growth, G, was mainly determined by the saving rate, about G, able S, bes M. Implication: stable growth was precarious because any mismatch between the actual and required growth rates could lead to instability.
A fixed capital-output relationship could paradoxically lead to unstable growth. Now, shifting focus to inequality at the individual level where these forces really impact lives.
Exactly. From the big picture, we now zoom in. A key finding: 20th century reduction in inequality wasn't some natural outcome of development, like Kuznets suggested. It was mainly due to the world wars and policies like progressive taxation and the welfare state.
And that trend didn't last forever.
No. Since the 70s, inequality has been rising again, though differently across countries. This suggests that institutions and political choices matter a great deal.
So policies and systems do shape how wealth is distributed. There's also this question of inherited wealth versus labor income. What's the common assumption, and how does the research challenge it?
The assumption, especially in democracies, is that growth favors labor income, that inherited wealth becomes less important. But this research suggests inherited wealth could make a big comeback in the 21st century, especially with slower growth.
A recurring theme. And looking ahead, how might 21st century inequality compare to the past, even to the 19th century or traditional societies?
We need to ask, could inequality reach those extreme levels again? Or resemble those in traditional societies where land ownership was highly concentrated? Understanding individual-level distribution is key to answering this question about our economic future.
Before that, the outline mentions Vautrin's lesson to Rastignac and Père Goriot. Why is that relevant to wealth and income?
Père Goriot, published in 1835, shows the difference in economic power between those relying on labor and those with inherited wealth. Père Goriot sacrifices everything for his ungrateful daughters, while young Rastignac tries to climb the social ladder. It portrays the power of inherited wealth and the limitations of even successful careers. Vautrin's cynical advice highlights this. Income from owning assets outweighs even the best-paid professions in a society shaped by inherited fortunes.
A literary lens for understanding economic realities that still persist. Now, to understand actual levels of inequality, there are those distribution tables. Can you give examples of what constitutes low, medium, and high inequality?
These tables show the magnitudes. Low labor income inequality, like in Scandinavia in the 70s, 80s, might look like this. Top 10% earn just over 20% of labor income. Bottom 50% get around 35%. The middle 40% get roughly 45%. Not perfect equality, but relatively even.
And capital ownership tends to be much more unequal.
Much more. Even in those Scandinavian countries, the richest 10% often owned 50–60% of all wealth. If average wealth is $200,000, the top 10% owned $1.2 million on average.
And it doesn't stop at the top 10%, right? More concentration within that group.
Exactly. If the top 10% owns 60%, the top 1% within that might hold 25%, the next 9% hold 35%. So the wealthiest 1% are 25 times richer than average, while those in the next 9% are only 4 times richer.
So it's the very top holding a disproportionate share. The outline prefers these tables to the Gini coefficient. Why?
They give you a clearer, more concrete understanding. You see the actual income or wealth held by different groups. It's easier to grasp where you fit in and how growth is distributed. The Gini coefficient summarizes overall inequality in one number, but it can hide important details.
You see who gets what, not just a summary. And these tables align with national accounting methods.
Right. National accounts give us total income and wealth. Breaking them down into shares held by different groups is a logical next step. We can then track how growth affects different social groups, especially the very top.
What's the key lesson about wealth distribution in developed countries when we look at this data?
The key takeaway is that their histories are surprisingly similar. We see this across-the-board compression of inequality in the first half of the 20th century.
But that period of greater equality wasn't inevitable.
Exactly. Inequality's history is chaotic and political, shaped by economics, social movements, politics, wars, even cultural shifts. Inequality is intertwined with all these factors.
To understand wealth distribution, you need to understand the context. Let's delve into that 20th century transformation. What were the main trends?
From World War I to the late 1970s, income inequality decreased significantly in France and other developed countries. The top 10% share fell from 45–50% to 30–35%.
What led to this shift towards greater equality?
It was primarily driven by the World War's physical destruction, inflation eroding wealth, price controls. Also, progressive taxation on high incomes and inheritances, and the welfare state unemployment benefits, public pensions all played a role.
A combination of disruption and policy responses. But there's also the issue of capital income reporting on tax returns.
Right. Capital income dividends, interest, capital gains has historically been underreported. Our estimates of the top decile's income share might be slightly low, but this doesn't change the overall trend, a major compression of inequality in the early 20th century.
And then, in the 1980s in France, this trend reversed. What happened?
Around 1982–83, we see inequality rising in France. The share of profits in national income goes back up to pre-1968 levels. By 1990, they've largely recovered. But it's not a simple reversal. Capital share as a whole, including rent, other returns to ownership, continues to grow in the 90s and 2000s. This relates to the capital income ratio returning to pre-World War I levels. Inherited wealth becomes more important, but income inequality figures don't fully capture this long-term process.
So capital's resurgence is central to rising inequality. What about the explosion of wage inequality in the U.S.?
The huge wage inequality increase in the U.S. and somewhat in Britain and Canada since 1970 is a major factor. Recent research shows 60–70% of the top 0.1% earners in the 2010s were top managers, not superstars like athletes or artists. It's the rise of super managers.
And the traditional explanation that they're just much more productive doesn't quite hold up.
No, it doesn't. The scale of their pay increases and the variation across countries with similar technology suggest other factors are at play, things like corporate governance and executives' power to set their own pay. Also, U.S. inequality in the 2000s was higher than in some poorer countries again, challenging the productivity explanation.
That's a stark contrast. How does the income growth of the top 1% in continental Europe and Japan compare to Anglo-Saxon countries?
Since 1980, their income share growth has been much slower. There's an upward trend, but not as dramatic as in the U.S., U.K., or Canada.
Again, highlighting the role of specific policies. Before World War I, how did top income shares compare across those different countries?
Pre-World War I, the top 10% income share was similar across major European nations, 45–50%. The U.S. was slightly lower, just over 40%. After World War II, the U.S. was slightly more unequal because the decline in Europe was steeper. From 1950 to 1970, shares were stable and similar 30–35%. The real divergence started after that, with the U.S. reaching pre-World War I European levels by the 2000s, while Europe shows a wider range now.
Convergence, then divergence. And the data limitations for Germany during World War II.
It's harder to be precise about German inequality during the war. Unlike France or Japan, which consistently collected tax data, there are gaps in German records. The data from 1950 onward suggests a return to the pre-war pattern, but the exact timing and scale are less clear.
So the overall trend likely holds, but the specifics are uncertain.
For more videos, don't forget to subscribe and like the videos.